Welcome to the Spotlight Podcast, where we put the spotlight on great entrepreneurs and leaders from across the world. Now, here is your host, Mr. Marcus Cobb.
What's going on, everybody? This is the actual first show of 2020. Happy New Year to everybody. And I'm just so excited to be back and doing my thing, as always. And welcome to the Spotlight. I am your host, Marcus Cobb. And today, I have a good special guest, not other than a person that I interviewed last year for the Dallas Means Business. And I had, given the fact that we are at the beginning of the year in a new decade, I wanted to bring him in to really talk about wealth, where we see things going in the next decade, and definitely for the year of 2020. And I'm just so excited to have him back and really talk more about that. And I really want to introduce him, not other than Mr. Eric Hudson. What's going on, buddy?
Hey, what's going on, Mr. Marcus? Good to see you again.
Thank you. Likewise. It's just been pretty much a year since I, spoken to you, but to give my audience, really a good quick background of what you have really accomplished, I'd really like for you to talk more about what you have done and why you got into the wealth management field. What were your successes and challenges?
Sure. So I'll just back up for a moment to the beginning. So I first sparked the interest per se, although I didn't know it at the time precisely that I was going to be in wealth management. I'll say during my early teenage years, I pretty much I got a little frustrated growing up, to be honest with you, about our financial state, our financial status, so to speak, within the household. Long story short, I've always been an avid book reader. And so during my teenage years, I started to incorporate books about investing and finance and things of that nature. And I first started investing at 21 years old. So that's about roughly 13 years ago. And I started, several different small businesses and startups and things of that nature and so on and so forth. And did my undergrad at Alabama A&M, studied business management, played collegiate football there as well. Fast forward to graduation, I did several years in the Army, did active duty. And the reason why I did that is because I grew up playing football, and like any little boy running around with the football, you have dreams of going pro someday, right?
That's right.
But my dreams didn't quite pan out to that point, as you can see. So my fallback plan was always to become G.I. Joe, another one of my childhood idols. So I went to the Army, did that for a few years. I still wasn't exactly sure what I wanted to do, Marcus, but I knew that I had an interest in investing from my teenage years and entrepreneurship. And so when I got out of the Army, I basically, I interviewed with several different companies, and I pretty much just took the highest bidder. And that brought me here to the Dallas area. My last duty station was in Fort Hood. So I was based out of Killeen, Texas, roughly 2 hours south of here, of Dallas. And so I ended up joining a building materials manufacturing corporation, and I did that for several years. And after my first couple of years of working with this particular company, one day a light bulb finally went off. I had been investing on my own, again, for quite some time, and then one day a light bulb went off because, slowly but surely, friends and things of that nature, associates, started to ask me for investment advice. And so one day it just clicked, like, why not? This is what you love to do, and you already have people coming to you for advice. Why not just turn it into a business? And that's when I went in head first, and I started to go through the process. You asked what were some of the challenges. I'll say the financial services industry in general is pretty heavily regulated. So my initial challenges were getting through the registration hurdles, the regulatory compliance requirements, having to go through all the background checks and background screenings and get all my legal documents and paperwork in place and submit that stuff to the state and the financial authority and so on and so forth, and go through my exams and the licensing. And so that was quite rigorous in a way, because it's hard enough for professionals who are working as financial advisors to make it in this business, even with joining a well-known established firm, let alone starting from ground zero like I did, from the ground up and building up the practice of business from scratch. So those are definitely my biggest initial challenges. And I'll say my secondary, my next biggest challenge was to really focus in on positioning myself financially to break away from the day job, to do what I love to do every day and run a business. So that was the other big challenge. And so I had to really hunker down and make some significant sacrifices in order to position myself to be able to break away from the day job and do what I love to do every day. Other than that, as far as successes, I mean, I'm living my dream every day now, and I feel very fortunate. I feel very lucky. I get out of bed every day excited, ready to get after it, every day of the week, including weekends. And and that I would attribute that as the success. Of course, we all have end goals. We have, point A and point B, where we want to get to and how we want to get there. But success for me is the act of progressively working towards a worthy ideal. Progressively working towards a worthy ideal. And I got that from Earl Nightingale. He's a pretty well-known speaker, and I listen to him quite a bit. And so, and that's what I'm doing every day, living my dream. So it's been good.
Oh, man. So I take it, based on what I see, is that you were very disciplined from a very early age. And it showed pretty much throughout, the years that you didn't let no obstacle, no anything interfere with where you were trying to go. And so that's very important, especially for young entrepreneurs who are just starting out. They really need that strong discipline. They need that eager to really get out there and do it every single day, including weekends. So when you bring that up, that's just a very valid point. So I really commend you for that. And now that we enter in a new decade, which is 2020.
Happy New Year, by the way.
Most definitely. And, a lot of the new old rules really, I guess, would say are not going to apply, I guess, as time goes on, really in the wealth and, investing field. So what I really want to say is, what do you see as the biggest opportunities in 2020 and beyond?
Okay, so I'll highlight a couple of things, and the first thing is, if we back up to 2019, as we start to get into the third quarter of the year, enter into the fourth quarter, I'll say September timeframe-ish, September, October, we start to see the major wirehouse broker dealers slowly but surely, a bidding war basically took place where historically broker dealer firms such as like a Fidelity, like a Charles Schwab, like a TD Ameritrade, they would charge commission fees. So let's say, for example, Marcus, if we backed up 2 years ago and you open up a brokerage account, an investment account through TD Ameritrade, so that you can start buying and selling stocks and start building up your portfolio and so on and so forth. Their commission fees was roughly $6.95 per trade. So let's say if you go into your account, into the system, and you put in a buy order, I'm just throw out a random name. Let's say you put in a buy order to purchase 20 shares of Starbucks. Now whatever the price of those shares are is obviously what you're going to have to pay to execute that transaction. But in addition, you have to pay that $6.95 trade commission fee that's being charged by TD Ameritrade. And so interestingly enough, what started to happen in 2019 is that one broker-dealer lowered their fees from $9.95 to $6.95. And then a competitor did the same thing. And then, Charles Schwab, for example, lowered their trade commission fees down to $4.95 per trade. And then, Fidelity and everyone else started to follow suit. And then, don't quote me, but I believe it was Charles Schwab. They were the first to drop their trade commission fees to $0. And of course, the same thing, or to compete, Fidelity and the others, they fell in line and did the same thing. And so my point is that as an investor, historically, where some of your cost to trade stocks, bonds, ETFs, some of your cost would come out of your investment capital to pay for those trade commission fees. Now that's gone. And so that creates a huge opportunity, especially for the smaller guy, the smaller gal to get started, because now there's no longer any trade commission fees. So essentially the barriers to entry have opened up that much more. And so that creates a major opportunity. And the second thing I want to highlight as far as opportunities in 2024 investing is that another thing that started to kind of catch fire, so to speak, again, going back to the big wirehouse broker-dealer firms, they began offering what's called fractional shares. Okay. So, for example, Netflix, again, don't quote me on this, but Netflix is probably trading around $1,200 to $1,300 per share. And that's pretty steep for someone who is just trying to get started and don't have a lot of investment capital to begin with, right? So now with fractional shares, you can go in and purchase, let's say, a quarter of a fraction of that. And you can still be able to buy shares of Netflix, but just at a fractional share price. So again, barriers of entry have opened up that much more, with the abolishment of trade commission fees. Now, granted, there are still some broker-dealers out there that charge a trade commission fee, but your mainstream broker-dealers, they're all at zero commission trade fees now. And then the opportunity to go in and purchase fractional shares. Now, the average guy or gal who just wants to break into the investment market, there's a great opportunity to get in now.
Oh, wow. With so many opportunities there, it's just it can be overwhelming, especially for a new investor. But for you to break down some of those, this really can go a long way. But to piggyback off 2019, it's been all over the news that I would say also at the very beginning that our economy was great, and which it is, and unemployment is very low, especially in the African American community. A lot of the stock market has really gone up significantly. Should we be concerned of a recession in the next decade? Should we be concerned that a bubble is going to be coming near? With all the good news, it's bound to maybe burst. Should we be concerned about that?
The short answer, my short answer to that, Marcus, is yes, and not yes in a scary way. So let me frame this up. The way I understand the economy, how it works, the mechanics of a economy is recessions are a necessary evil. And I don't mean evil in the literal sense, but figuratively, let me use a metaphor as an example to compare it to that I think a lot of the population can relate to. So let's say, and this is real life example pertaining to myself. I recently made a significant change to my diet. Officially, as of December 26, 2019, I transitioned from a heavy animal-based diet, which has been my entire life, and overnight I transitioned to a 100% whole food plant-based diet. Now, based on the studies and the research that I've been doing up to that point, I was aware that there's a very, very good chance that I would get really sick once I make that change. And part of the reason why I would get really sick is that the body will go through a self-healing process. And that self-healing process consists of detoxification, basically, with all of the mucus and the toxic waste and all that stuff that I've been consuming over the years and years. And, they're very common. A lot of leakage would take place, mucus leakage from the nose, the eyes, the throat, and some of that waste will start to get into your bloodstream, so it'll make you feel really weak. It can cause headaches. So personally, what happened to me is within the first couple of days, I felt really weak. My eyes, my nose were running like a faucet. I had headaches, and I vomited multiple times. And it took several days for that to run its course. But on the other side of that, I feel better than I've ever felt before. Now, let's compare that to a recession. The reason why recessions are necessary because a recession essentially detoxifies the economy of, let's just call it corporate bad guys. Corporate bad guys in the sense that those who mismanage the budget, those who, they have the entire C-suite, flying private everywhere they go. Meanwhile, on the books, the company has lost money over the past 3 months. Misappropriating funds, over leverage, too much debt on the balance sheet, and so on and so on. Giving out bad loans, and what have you. And so what a recession does, it cleans out the economy of bad businesses, and it opens up the doors and creates opportunity for new interest, newcomers to step in and start to supply better service and better business, better products, and so on and so forth. And so recession is necessary. If you look at historically the economy, whenever the economy as a whole, and it's primarily driven by debt, pretty much in every case, whenever the economy as a whole becomes too weighed down with debt, basically we're taking it too far, and companies have been irresponsible. Inevitably, a recession comes at some point, and then the companies who should go out of business usually do, barring a government bailout. That's a whole different subject, so I won't go there right now. But barring a government bailout with tax dollars, the companies that should go out of business usually do during recession, and rightfully so. Now, as the individual, as the family, how do you protect yourself against a recession? And the most basic way to protect yourself against a recession is to make sure you're not in a position where you're living check to check. In a nutshell, basically economize. And what economize means is to make the most out of the least. And so in other words, when times are good, be frugal. And the reason why you want to be frugal when times are good is so that when times are bad, you are well positioned to prosper. So a lot of the well-known famous investors of our time, like, the Warren Buffetts, Ray Dalio, and I can go down the list, a lot of them have made their fortune when the market drops. And then because they well position themselves financially to take advantage of the discounted investment opportunities that present themselves during a recession. And so I do think a recession is on the horizon. Don't ask me when. No one knows when that may happen. But, as someone like me who studies the markets every day and I'm constantly looking for new investment opportunities, it's become more and more difficult to, based on my particular metrics as a value investor, it's become more and more difficult to find lucrative investment opportunities where I can buy in below what I have calculated a particular business to be worth. And in a lot of those cases, their balance sheet is heavily weighed down with debt. And so I think we're about due from an economic standpoint for a cleansing. In other words, a recession. So, yeah.
Oh my. So definitely I was very prepared for that, given the fact that, it's been at least between, I say, between a decade to 12 years since the last recession.
Mm-hmm.
And so I thought that it was time to really get prepared, definitely get in position to get set for another one. And which brings me to the next thing is that, 80% of families, live paycheck to paycheck. And so with that being said, African Americans is a lot higher. And so I wanted to really get your advice on what to, for building the wealth gap between the African Americans and other groups. Because for us, the rules don't apply to, other minority groups. And so what would be your advice for really bridging that gap?
So your question is how to bridge the wealth gap, specifically with Black Americans, right?
Correct.
All right. Okay. So a couple things there. The first thing I would touch on is fatherless households. Bridging the wealth gap, it has to start in the household. It has to start at home. So just to throw out a couple of numbers, statistically speaking, prior to the civil rights movement, the percentage of Black American children being raised in single-family homes was roughly 40% range. Post-civil rights movement till present day, the percentage of Black Americans being raised in single-parent homes has jumped up to roughly 75%. So that's a big jump from the 40% range to about 75% to present day. And it makes you beg the question, why? What happened? What significant events took place that contributed to that big jump in Black American children being raised in single households? And also, let me mention that as that figure, as that percentage has been increasing as far as children being raised in single-family households, the poverty levels have been rising congruently with that figure. Okay, so again, it begs the question, why? What happened? So if we think about it, what took place during and after the civil rights movement, the major events that took place is that the government stepped in and made a deal with the mothers. And basically the deal was and is, hey, if you kick the man out of the house, I'll cut you a check every month. And unfortunately, a lot of people have accepted that deal. And that's a big reason why Black Americans, they come up in welfare, and then it starts a cycle of generational welfare. So to answer your question, first and foremost, in my opinion, it has to start in the household. We have to get back, as Black Americans, we have to get back to two-parent homes when raising children. Children that are raised in a two-parent home versus a single-parent home it's not even close. Significantly have greater chances of succeeding later on in life.
That's right.
So we have to get away from the welfare programs and get back to two parent households. And again, and going back to my personal upbringing, and I can think back to high school, my junior and senior years. I saw a lot of my classmates walking around pregnant, and my associates, my homeboys, having babies on the way. And so I just want to throw out there, it's okay to postpone. It's okay to postpone bringing children into the world. It's okay to delay that for the time being, and work on establishing a foundation. Get into your career, build a solid footing. Make sure you take some time to actually find the right partner as far as a potential spouse. It's okay to delay it, and as a Black American myself, and I, coming from, welfare and that same background, I've seen it a lot. I've seen it, within my lineage. I've seen it around me, where, people haven't, bringing babies into the world before they given themselves a chance to really give themselves a solid footing. So, short answer, Mark, is I think it has to start in the home. Get back to having a good, wholesome families and two-parent households, and then so that begs the question: what if, you're an adult, you're a product of a single-family home? Now what? What do you do, right? So my suggestion would be, and just very simple, very basic. Number one, stay out of debt. If you are in debt, work your tail off to get out of debt, and then save and invest. So if you're a product of that particular environment, you have no control over the cards that are dealt with you. We can't choose our mother. We can't choose our father. We can't hand select our siblings. We can't choose our grandparents. We have no control over the environment that we're born into. However, the onus is on us based on how we write our storybook ending. So I read novels a lot. I read books. So I look at life as a book full of chapters. And chapter one, we have no control over what chapter one is going to look like.
Yes.
But those final chapters in life, the storybook ending, is completely within your control. And so it's up to you to write that desired storybook ending and pursue it and get yourself out of welfare, generational wealth, and start building wealth so that we can start narrowing that gap with the Black American community.
Oh, most definitely. And with that, there has been recent in the news that there have been new rules for the 401ks. So a lot has changed within that. So now, from what I've been told and from what I've been reading, is that now we can contribute more to the 401k for retirement. So if you could explain what are those new rules for 401ks for people that are employed and definitely for taking the self-employment route?
Mm-hmm. So the new rules as far as 401ks, and that also includes IRAs, individual retirement accounts. So the actual write-up itself is pretty lengthy, but I'll just, for the sake of time, I'll just point out a few highlights. Yes. And the first thing I'll highlight is that, and this is in regards to required minimum distributions. And what that means is if you have a 401k or if you have some type of individual retirement account, required minimum distributions basically means that you must begin to withdrawing funds by X amount of time frame, whatever. And so previously the set age, the rule, so to speak, was that you had to have taking distributions by age 72 and a half. since the implementation of the new laws, you're not required to start taking minimum distributions until the age 70. So that's one of the key changes with the new law. And by the way, the law is called Secure Act, the Secure Act. So if any of your listeners want to take some time to go look that up and read up on it. The second key change that I would like to highlight is that the age restriction for contributing to a 401k or contributing to an IRA prior to the new laws, the age restriction was capped at 70 and a half. Now you can contribute to your 401k or your IRA well beyond 70 and a half, granted, if you're still generating earned income. And so that to me, that's a big win, because medical technology continues to improve, and I think slowly but surely, people in general are starting to put more focus on their diet and nutrition, and in other words, we're starting to live longer and longer. And so and today, in today's day and age, I don't think it's not too uncommon for people to go on working beyond 70 years old. So I think that's a big win. And the last thing I want to highlight with this particular subject with the tax law change is that this is a change regarding to inherited IRAs or inherited 401k, whichever one it may be. So before the change, before the new laws were put in place, for example, let's say if Marcus, if your parents they passed on an IRA to you, so you inherited your parents' IRA. Before the law, prior to the changes, you could drag out the distributions of that IRA over your lifetime. Now with the new law changes, you have to withdraw from that inherited IRA within a 10-year time span, unless your spouse or if you're somehow medically incapable of providing for yourself, or if you're under the age of 18, basically, you're not in adult age yet. But other than that, the new rule is that you have to draw down all of those distributions from an inherited IRA within a 10-year time frame. So those are some of the key highlights that I will point out. But again, I highly encourage your audience to go check out the Secure Act, the actual document, and read through it, and then get with look at your assets, get with your trusted advisor, and really dive into how that may impact you going forward, and then plan accordingly.
Oh, most definitely. And being that we are both in business and self-employed, there's certain investments and retirement plans that are, probably best, particularly for, business owners. And I want to get your advice on what would be the best vehicles for retirement for, entrepreneurs.
Okay. So I'll highlight, let me just highlight two options, two pretty common options. And the first thing I'll highlight is the solo 401k plan. So this is called the solo 401k plan. And first off, just to preface this, there are retirement plans available, such as the solo 401k plan that I'm about to speak on, for the self-employed entrepreneur. And the reason for that, the reason why these vehicles have been put in place is so that, as someone who's self-employed or an entrepreneur, you don't have access to a employer-sponsored 401k plan.
Correct.
Because you're doing your own thing. So in order for you to be able to reap the same tax advantages as someone who is an employee, these self-employed retirement plans have been put in place. So the first one I will highlight is the solo 401k plan. And again, that comes with pretty much very similar tax advantages that comes along with a traditional 401k as someone who is an employee. But the kicker with a solo 401k plan is that you can only use that for yourself and your spouse. Anything beyond that, you can't utilize a solo 401k plan. And so that's why in a lot of cases, another option is called the SEP, the SCP plan. And SCP stands for Self-Employed Pension Plan. And so with the self-employed pension plan, you don't have you don't have as much restrictions or limitations. You can expand well beyond just you and your spouse. So if you want to bring on employees and staff up and scale. So essentially, as self-employed entrepreneur, if you're happy and content with your small business operation, your practice, and you have no desire to expand beyond a one-man show or your spouse helping you out, then a solo 401k plan might be the best fit for you. But if you plan on growing at some point, you want to scale and so on and so forth, then you probably want to look at the self-employed pension plan option. So,
oh, definitely, because now I'm really focused on my retirement. Really focused on because now I'm thinking really about the family thing. Because I'm getting at that age. Because we're almost close to that big 4-0. So definitely now is even more serious to really think about the retirement, which is not so much what I was thinking about maybe 10 years prior, 10 years ago. But while I'm still very young, because I consider, my age very young, that retirement is just a huge thing, number one priority for me, especially as a business owner, because if things, pretty much go south, I want to be able to have that cushion, be able to know that my family is taken care of. So that's why it's always good to get that good advice on where to put your money at in the future. And to step back a little bit, going back into the stock market, what companies do you, I would say, would be to invest in as opposed to being like in the stock market? Because there's certain companies that you want to buy stock from, you want to really invest in. So I was just saying, like, now that we're into the new year, where should we like put our money into, I would say?
okay. So I'm going to have to answer that question in kind of a roundabout kind of way,
Okay.
due to regulatory mandates. I'm not going to make any specific stock recommendations to the general public. But what I will say is that as far as opportunities, especially with this long historical bull market that we've been going into, and like I said previously, opportunities for the smaller guy or smaller gal are really starting to open up a lot more. For example, since we've been on this long bull market run, you have existing institutional investors who are really starting to mature now at this stage of the game. Like you have, I won't name any specific firms, but you have some institutional investment firms who, let's say, 20 years ago may have had, $50 million under management to invest. Fast forward to today, they're managing, several $1 billion to invest. And at that size and scale, they can't look at the much smaller investment opportunities, because on a much smaller level, it's not worth their time because it won't be enough to move the needle. So once you get so big, you can only you're now restricted and pretty much limited to only the big, more gargantuan mega deals. And so as more and more companies start to mature and reach that scale, on the bottom layers, it starts to open up more slots, more opportunities for the smaller guy to get in. So as far as opportunities and someone who wants to start investing, that's definitely something I would start paying attention to, and jump in and see where you can start taking advantage.
Oh, definitely. Now, the last thing I really want to say before we wrap up, I just want to say that investing is just such a huge topic, and for a person that's really, and you just mentioned that for just starting out brand new, if they were just coming out of college, or if they just, really got that financial education, where would they really begin? Because it can be like overwhelming. We could read the books, we could, attend those seminars, but just to give like a really simple answer, or simple place where they don't have a lot of money in the account to pretty much buy certain things, where would be, the best place to begin, you would say?
Okay. So for someone who is just getting started and doesn't have, a lot of capital to start investing with, I would say whatever portion that you do have set aside to invest, just to get some skin in the game, take a small percentage of that and put it into an index fund. An index fund is basically, there's several different indexes, such as the NASDAQ, the Dow Jones, the S&P 500. And basically what an index fund is, let's look at the S&P 500, for example. The S&P 500, which consists of the largest American-based, the 500 largest American-based companies based on market capitalization. And so if you buy a S&P 500 index fund, you essentially get a small piece of, each of those 500 companies. So I would say that generally speaking, that's a pretty good place to start. Put a small portion of that into an index fund just to get some skin in the game, just to get yourself acclimated and build up your comfort level with actually being invested in a market. Because the other thing is the sooner you start, the better, so that your time horizon can work in your favor, so that compound interest over time can start to work in your favor. So I would say start there, and then once you get a little bit of skin in the game, now don't bet the whole farm just starting out. So take a small slice, and once you get a little bit of skin in the game, actually go through the financial planning and investment strategizing process. And for me, with my firm, I pretty much break that down into 3 basic phases. Okay, so phase number 1, we want to identify where you stand today. Phase number 2, we want to define where you want to go. And so phase number 3 is basically in between 1 and 2, whereas phase number 3 is all about strategizing and developing the actual blueprint, the roadmap to get you from point A to point B. And so while we're recommending starting with those 3 phases is to track your net worth. And so I built, what I use with my clients a lot is I built what I call a net worth tracker. And it's a one-shot snapshot Excel spreadsheet with, I'll put the formulas in it and everything. And basically it's a one-shot snapshot that captures your monthly income. It captures your monthly expenses line by line, and it calculates your net cash flow per month, and it also captures your assets and your liabilities. So your assets, anything that you own, your savings accounts, your investment accounts, if you own your home, if you own art, whatever it may be. And then your liabilities, of course, is anything that you owe, your debt. It could be credit cards, it could be an outstanding mortgage, it could be a bank loan, whatever the case may be. And once you plug in all of your information, your figures, at the bottom of that, it calculates your net worth. So your net worth gives you a clear-cut picture of exactly where you stand today. And also, with something that's laid out that way, you can clearly see where you can make some adjustments at. And so start with your net worth tracker. And then from there, you want to you want to identify your actual start building up your actual investment strategy, and a common course of action for that is to go through some type of investor profile questionnaire, like something that's going to ask you. You're going to answer a series of questions pertaining to, preferably pertaining to your financial goals, your short term, your long term financial goals, your time horizon, meaning what projected age do you plan on retiring, and how much money do you think you're going to want or need to live off of at that point in time, and your risk tolerance. Basically, how much risk can you stomach as an investor? You know, are you more of a passive, moderate investor, or are you more of a risky, aggressive investor, or do you fall somewhere in the middle, in between? And so you want to capsulate all of that data, you know, put all of that into a bucket, and then, you know, move some pieces around, refine it, and then once you've gone through that entire process, you should have a laid out plan of where you are, phase one, where you want to go, phase two, and how to get there, phase three. So
definitely. And so what really sets the Hudson management firm from other financial advisory firms? Because, you know, you offer quite a bit as a, you know, a business owner. And so I know that really stepping out there, really creating your own wealth management firm, what really sets Hudson management, you know, firm from others? Because I know that people can charge, you know, a lot of commissions and everything, but, you know, you bring such a unique approach to wealth, especially for the African Americans. So I really wanted for you to touch briefly on what really sets, you know, Eric Hudson from all other advisors out there.
Okay, you just mentioned commissions, so I'll touch on that first. We don't charge any, or nor are we compensated through any type of commission-based fees, and the reason for that, and what that does, is eliminate any inherent conflicts of interest between the advisor and the client. So, for example, if you have an advisor who and I'm not knocking it, you know, not every advisor acts in this manner, but it does put said advisor, it can very well put them in a precarious situation. So, for example, if you have an advisor who's struggling to get their footing, and, you know, they got bills coming up next month, and they haven't hit their numbers, their commission quotas for the quarter, and, you know, usually the way commissions are set up is you have various different financial products that you can sell to the public. It could be, you know, mutual funds, annuities, life insurance, whatever. And usually, you know, it's a tier. Like, certain financial products they have pay a higher commission more so than others. And so it can really put an advisor in a compromising position if their own livelihood is on the line, and they have two products they can recommend to this client. Product A is may definitely be much more in the best interest of the client, but it doesn't pay as high of a commission as product B. Product B may not be a terrible product. It might be suitable, but it's not as well suited as product A. Given those factors, you know, an advisor may be in a sticky situation where they may opt to take the higher commission, especially with a firm who prioritizes sales quotas and things of that nature. And so, first and foremost, there's no commission-based fees within my firm, no sales quotas, and the other thing that I want to mention as far as, you know, differentiator is that we don't incorporate any type of sales pitches at all. No, there's no advertising, there's no promoting, none of the sort. So every client that I have and everyone that we do business with, they've either come to me by word of mouth, or they've come to me by they came across one of my published articles, or, you know, some of my content, or, you know, somewhere along those lines. It's always a inherent or organic client advisor relationship from the get-go. So we don't do any promoting or soliciting of our services, and I think that really sets us apart from everyone else.
And so, what is next for you, Mr. Eric? Now that we're into the new year, what is next for you and your company? What do you see your company going this year and beyond? Is there any particular uh, place where you want to be in the next 5 years, um, or are you feel like you're already there?
Well, I never feel like I'm already there. To answer that question, I'm always, always have targets in place that I'm working towards getting to. And but as far as new things on the horizon, I'll say internally, really quick. I'm making some technological upgrades with our trading platform and our CRM systems. That's a lot more advanced and robust compared to what we're using previously. And more importantly, that's going to significantly enhance the client experience. So I've been rolling that out slowly but surely with each client, but I'm really excited about that. And as far as more distant targets such as 5-year targets, 10-year targets, and so on. I a big part of what I do is that, as far as my contribution to the economy is creating jobs. So if we're talking about, 5-year targets, I have, X number of staff or jobs that I want to create by that time, not only to grow the firm and scale the firm, but as far as contributing to the economy. That is very near and dear to me, very important to me. I'm a big proponent of, instead of complaining about whatever the economic issues may be, I always ask the question, what are you personally doing about it? Like, if you feel like the job market isn't where it needs to be, if you feel like the hiring process isn't fair, if you feel like there's, identity bias within the recruiting system, what are you personally doing about it? I always throw that question out there. And so I take on that ownership, and that's a big part of my mission. So,
Oh, so lastly, I just want to be able to give my audience where could they find more information about you, Mr. Hudson? Where can they get in contact with you? What is your website and everything? So I really want them to know all the details of where they can get in touch with you and really get the really not just the education of wealth, but just to be able to really do business with you. I really want them to know who you are and where they can get in touch with you.
okay. So for one, you can go to our website, which is www.hudson-wealth-management.com. So that's hudson-wealth-management.com. And I'm also very active on LinkedIn. If you just go on LinkedIn and you type in Eric.K.Hudson, usually my name is the first one to pop up, and you can connect with me on LinkedIn. I'm always publishing different articles and posting different videos through that particular platform. So you have our website and LinkedIn, and you can also shoot me an email. My email address is ehudson@hudson-wealth-management.com.
Oh, wow. I just want to say thank you so much, Mr. Hudson, for coming through to really speak on my podcast. I can't really thank you enough. I know this is the second time we've done an interview, but really I would say your definitely your wisdom, your advice, really to my group, to the young generation has really benefited me in so many ways. It really put me in more focus of really thinking about my future, really thinking about the legacy I want to leave for my children, definitely things that I really want to accomplish and get done, while I'm still in my 30s. And so really bringing you on and really educating us on really the wealth, definitely stock, what we see in 2020, it's been very informative. And so I thank you so much for coming through. definitely come check us out. Definitely check Mr. Eric Hudson's website out. Check his LinkedIn profile and definitely get in touch with him with any other questions that you may have about definitely building wealth, especially in the African American community, and definitely about personal finance. Definitely get in touch with him. Really, he can point you in the right direction and really give you a sense of where your money needs to go. And this concludes our broadcast for the Spotlight. I am your host, Marcus Cobb, and tune in the following week as we will be talking more about definitely more wealth topics, and definitely I will be bringing in more guests. So this is just the first show for 2020. It's off to a very good start, and there'll be a few other things coming up in this year. So we will be doing a special show in New York. I can't give the details yet, but definitely we will be doing a lot of big things in 2020. So look for that. And until then, I will see you on the next broadcast. And y'all have a great weekend and take care. Bye-bye.
Thanks for listening to the Spotlight Podcast. Be sure to subscribe on iTunes, Spotify, and other major podcast platforms.
Is that a wrap?